on WPG Talk Radio 104.1.
Hey, thanks very much. Welcome back. It is our first visit of the brand new year with the official, the exclusive financial advisor to the Hurley in the Morning program, Chuck Malamut. And this program is presented by Chuck, who is a financial advisor at Morgan Stanley. The information, views, and opinions expressed on this broadcast are those of Chuck. They do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of this broadcast and are subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only. Morgan Stanley Smith Barney, member SIPC. Mr. Malamut, Happy New Year, my friend.
Good morning. Happy New Year to you, Harry and Margie and your family. And
thank you.
I guess I missed my invite for the...
No.
Maybe I probably ended up in my spam folder.
Oh, no. I talked to you before the holiday. I told you you're invited. You're always invited.
I'm only teasing. So, Harry, you couldn't help yourself.
Oh, no, I had to.
I was coming in here this morning.
Well, do it. Do what you were going to do.
Both guns a-blazing, ready to go to congratulate
you. Thank you. Do it. Just do it then.
Congratulate you on your remarkable performance in the our annual Beat the Point Spread football pool for entertainment purposes only.
Thank you.
I think what I said, you probably
I was honored by
you probably
what you
took
wrote.
the email, and I'm surprised it's not up here on the board yet.
There's thousands of copies made
and framed. But what I did say, Harry, again, gosh, we've been doing this now. I don't know how many years now. At least I'd say 7 to 10, maybe more.
Oh no! It's more than 7. It's over 10.
But in any case, what I did say was that you finished first with 138 wins, 53.9 winning percentage. Fortunately, you did not advertise your picks in advance on your listened to Hurley in the Morning radio show, because if so, you would have crushed the bookmakers.
We would have had a good year.
There's no doubt about it. They would have lost a fortune. So I know we spoke over the weekend. You were considering early retirement from what you do with your day job, but
you advised me against it.
But we took a consensus vote, with the board of directors of our esteemed pool, and what we decided it'd probably be best, Harry, to continue in your day job.
Thank you.
So the question is now: are you going to be able to, kind of push the ball forward as we go into the playoffs?
Always tough,
because now we run another for entertainment purposes only that is not only point spread but also is the over under. So
that's the challenging
It gets very, very difficult, and not a lot of choices. So if you get it wrong early on, then you have a problem. But here's what's remarkable, and it's all about statistics. Because I went back and I look every year. The number 2 winner or second place finisher, we'll call it, was only one game behind you, and the number 3 person was actually 3 games behind you.
Yep.
And then there's I'm going to say a number of 5 to 8 people that are virtually right. They're all in the hunt. So, if something goes the wrong way or breaks in the right direction, it can make or break a season.
Well, like for me, I was 3 back going into the final week this weekend. All the games were on one day. And Chuck, as you well know, because you've been doing this, I think this is our 12th year. I'm almost positive it's the 12th year. I don't know how many times somebody has come back from 3 down in the final week. And then, of course, you're dealing with Pittsburgh didn't play Roethlisberger and didn't play somebody else. And they won, but they didn't cover the spread. I picked Pittsburgh. I shouldn't have picked Pittsburgh. I should have used my instincts and said, they're going to take a rest. But then you don't know. The Giants could have taken a rest, but they played everybody, and they won. I'm going to tell you what this came down to, Chuck, and it was extraordinary. I went to dinner with Margie at 6 o'clock to the Blue Pig Tavern, and I told Margie, I said, let's just have a great dinner. It's over. I've lost. I'm going to lose by 1 game because Atlanta was crushing New Orleans, and the second-place finisher, Ken, was on Atlanta. I took New Orleans. I was getting 6.5 points. New Orleans scores, and then they do an onside kick, and they score again. Then they get the ball back again, and I said to Margie, this is unbelievable. After our dinner was completely over, the game was still going on at like 7:30 in the evening. Our dinner, we were down there for about an hour and a half. And I came back. I said, oh, my gosh, Atlanta's probably going to play prevent. They're going to score. If they kick the extra point, I'm going to win the pool, the whole season championship, by one game in the most unlikely, improbable way. That's what shows you how crazy this is.
On a game that meant absolutely nothing.
Exactly. But New Orleans played like it was for the playoffs.
Well, they all look. They're professionals,
Yeah.
and you know, I don't want to spend a lot of time chatting about football, but I was just totally amazed in watching the Penn State USC game yesterday. It was.
I mean, Penn State had the game.
It was probably by far one of the best college football games I have ever watched, and
I had to call my dear friend Tom Cantone. Because,
he had to be heartbroken.
He's devastated.
It was
devastated. They needed one first down. I mean, they had the game.
Yeah, for to allow a team to score 17 points in the fourth quarter, well, with a freshman lights out quarterback.
Yeah.
It had look. They got it absolutely right in putting those two teams together. You know, you had a great game.
Unless they didn't get it right by not putting Penn State in the bowl playoff. I mean, they beat Ohio State. Ohio State punked out and did not play in the Big Ten championship. I think there was a lot of reasons. I know the pedigree and Urban Meyer and the pedigree of they're not Ohio State, the Ohio State. I mean, I know that, you know, they were almost getting a sort of Lifetime of Achievement award there, but I think you could have easily made the case that Penn State should have been in that game. And as we know, Ohio State got crushed.
Yeah, I think you're being very, very kind.
Clemson annihilated them.
Yeah, it was the field was basically lopsided. There's no doubt about it.
And Chuck, before we go off of the,
do I need to sign off and autograph?
I just want you to autograph it and date it.
Okay, I'll do it on a commercial, so I don't
give it
rush
back
it
to you.
here.
I just want to tell you how much this meant to me for you to write all these nice things about your brother Harry.
I do want you to know, Harry.
I think you could have wrote that I made a four-game.
No, it was very, very Harry.
Pickup.
It was very, very late.
Yeah.
In the evening, and I wanted to get it out before today's show.
But I will tell you, the thing I'm most proud of is going 11-5. I lost the weekly pool only on the tiebreaker by 0.2. A person ahead of me that did auto picks, and anytime I beat auto picks, I feel like it's a great victory because I love human intelligence, you know, over artificial intelligence when human intelligence wins out. I was within 3 points of the total point spread of the Green Bay Packers-Detroit Lions game, and the person that won that also was 11-5 for the week had 2.8. I never saw anybody even put anything like that in there. I've never even used half a point. I've always gone to the whole number. But the thing I'm most proud of, Chuck, is I was 3 down in the most impossible week of the season because you never know. I mean, for example, I picked the Eagles because I assumed that Dallas would not play key players. If Dallas had played all their players, I think they beat the Eagles, Chuck. Now, I didn't use that logic everywhere, but I picked and chose. So the toughest week to try to make up ground in this entertainment endeavor is that last week when so many positions. I mean, the Giants, for example, I don't know what made me believe that I should pick them because they had their place in the playoffs was set, and nothing would really change it. And they played all their people. And
can never figure.
So they won.
There's no doubt about it.
And they had some hook and ladder play that made them, beat the spread. All right. Anyhow, Chuck, I know you got a lot of information that you want to cover. Thank you for the recognition. And yes, this is my first overall championship.
So let's kind of get right into the year end, Harry, for sake of time. Dow Jones up 13.4%. S&P 500 up 9.5%. The Russell 2000, your small caps and mid caps, up almost 20%, 19.5%, and then the S&P up 9.5%. And certainly, Harry, I think if you took a step back and we had this discussion, and actually we have this discussion, we have it every year, and you say, what do you think? And I think, Harry, our mindset was that interest rates were going to increase and stock prices would be higher to the tune of anywhere from maybe 8 to 10%, and it would be somewhat of a stretch in getting there. And certainly when you take a look at what happened at the beginning of the year, it was very, very challenging. I mean, we all have pretty short memories. So, I guess as you were coining it earlier today, sort of a year in transition as we get into 2017. But if you look at 16, I don't think we could have gotten off to much of a worse start than we did. The S&P was down over 5% during the month of January. The Dow Jones was down about 5.5% for the month of January. So it was, and the media, as you know, will do everything in their power, to basically add fuel to the fire. So it was by far the worst start that we ever had, with the Dow Jones. So everyone, the media was saying, okay, this is just going to be an awful year. Look out below. It's just going to be the worst. So, what happened was, the Chinese stock market dropped 7%, in the first day of trading in 2016. So that set the tone for a month that we had concerns about their depreciating currency, falling oil prices, credit spreads that got very, very wide, earnings estimates that we basically went through that earnings recession, as referred to it, economic data that was disappointing at best, and then the Bank of Japan, and Harry, I know you remember this. They came out and they basically stunned the global markets with negative interest rates. And then you had that ongoing escalating tension between Saudi Arabia and Iran. So, deflation and recession were some of the buzzwords that were used early on during the year. And making the start of 2016, very, very, it was tough. So it didn't end in January, Harry. What happened was, as we got into February, we had additional selling pressure at the beginning of the month. The S&P at one point in time was down over 11%. And we hit that close on February 11th when the selling ended. And, oftentimes in our world, it's an event or two or an action that is taken by a company, an entity, an individual, government. But here's what happened. The low for the year was February 11th, and that inflection point was driven home by the disclosure that J.P. Morgan, the president of J.P. Morgan, Jamie Dimon, had went out on that day or the day before and bought 500,000 shares of J.P. Morgan stock, and in doing so, he took $26.6 million, out of his personal net worth. And I guess your listeners are saying, "Oh, geez, the guy's." It's nothing, it's funny money. But I think what happened was, Harry, it was a statement that was made that, the president or the CEO of a very, very large financial worldwide, conglomerate goes out and spends his money to go ahead and put, his faith back into not only his stock, but the general world economy as well.
Brief time out, 19 minutes past the hour. I'm going to ask Chuck to also sort of chronicle, has there ever been a 5-week period from first Tuesday in November to December 31st where so much of the year's gains took place? Because I think it's not a footnote to me. It is a real highlight reel that the extraordinary numbers for the year are largely because of the 5-week period from the election to the present. We'll be back, or till December 31st, as we're speaking about 2016. Then we'll transition into 2017 with Chuck Malamut, the official financial advisor to the Hurley in the Morning program. And Chuck's autographed congratulations to me is already up on the studio wall as we speak. I'm very proud of having that autograph, Chuck. Thank you for doing that. And this portion of our program is also brought to us by the exclusive golf club to the Hurley in the Morning program. to the Hurley in the Morning charity, the Harbor Pines Golf Club, because whatever the occasion, they know how to throw a party. I can speak to being their customer. They are my customer. And so from a wide spectrum of observation, I can share with you that the overall service atmosphere and their wide variety of programs and events, and they do such a great job for any occasion, reunions, retirements, birthdays, holiday parties, weddings, wedding showers, and so much more, and certainly golf outings. And when you're putting your next golf outing together, give Deb Stevenson a call, the only certified golf planner in southern New Jersey. Deb can be reached at 609-927-0006, extension 13, and great membership rates are available for a variety of distinct membership plans to meet your individual needs. Call 609-927-0006. They're at 500 St. Andrews Drive in Egg Harbor Township and on the World Wide Web at harborpines.com. 22 minutes past the hour. Thank you, great one. Another great one is Malamut, Chuck Malamut. For all of your financial planning needs, turn to the official, the exclusive financial advisor to the Hurley in the Morning program, Chuck Malamut. The Malamut Group is the team that Chuck is the managing director and leads at Morgan Stanley's Northfield, New Jersey office, 609-383-2010. And you, too, can figure out just with one sit-down with Chuck how he has perfected his concept of total asset management coupled with the all-important asset allocation. And that was important in 2016.
Well, Harry,
wasn't
it was, and I was thinking at the break that as we're going through the year, what actually happened. This is a classic case on spending time in the market versus trying to time the market. And imagine how desperate you would have been at the end of January, early February, down fairly significantly, from the prior year, thinking that, you're going to throw the towel and the world ends, and all of a sudden, in a relatively short period of time, the market, gets better footing and moves in an upward direction. So, February ended obviously in a positive fashion. The Fed was very, very confused as to what to do because we did not have any earnings growth for the fourth quarter in a row.
They wanted to raise interest rates,
but they couldn't.
And, Chuck, I want to go back even a little bit further. I remember vividly late 2015 when you were doing your usual, presentation of the year-end and looking ahead to then 2016. None of the analysts saw the ugliness of the first quarter coming. No,
they didn't. And Harry, not only that, I think most of the analysts missed what was going to happen in 2016. So as we get through,
they missed everywhere. They missed the first quarter that they thought was going to be good, and it wasn't good, and they missed the fourth quarter that was great that they didn't think was going to be great. And they missed, were rooting for the other side.
And they missed Brexit, and they missed the presidential election.
Yeah.
So I guess
when you
go 0 for 4, it might be time for their early retirement.
Yeah.
So we get to March, the S&P posts a gain of 6.6%, April up 2.7%, and May up 1.5%. And you would think you're about done at that point in time. So from the low that we made in February to the high that we made in May at that point in time, the S&P 500 was up about 15%. Again, proving that if you can get this right, then you're very, very astute. Or you're very, very lucky, and I'm going to say it's probably more the latter than the former.
But Chuck, generally speaking, if you had proper asset allocation in 2016 and you stayed and you didn't bail after January or February and you stayed through December 31st, chances are you had a very good year.
You did, but I mean, the thing about asset allocation, Harry, is that all markets do not increase or decrease at the same time. So what was happening is, and I'm getting a little bit ahead of myself here, but the low that we made with interest rate was posted in July. The 10-year it dropped down to 1.36%, and that was a result of what was happening, with Brexit. Interest rates at that point in time, the bonds were up significantly for the year. Equities were still in a very, very, positive direction, but sort of teetering, as to the next steps. But then what happened is we got to, the end of the year, earnings started to improve rather dramatically. We all know what happened with the election. And as you get to that fourth quarter in that 5-week period, we have not seen the kind of increases that we've seen this year, Harry. I'm thinking maybe even by all historical standards. But at the same time, interest rates, those that own fixed income, suffered somewhat because the 10-year, which I quoted at a 136 in July, was close to a 2.60%. Now, that means that if you own the bond at a 137 yield and you paid par or 100, in all likelihood that bond is going to probably be down 10% because you made that 130 basis point or so move in rates. It doesn't make bonds bad. But the beauty of asset allocation is you have to have a goal. And Harry, it's without having a goal, why have asset allocation and why invest your money? It doesn't make any sense other than for you going to a dinner or a party and bragging to your relatives and friends like how smart you are and what you did with all the stocks that you bought.
And your theory of asset management, asset allocation, is not even really, you want it to be right for 1 year, but you're really looking at someone's career. You're looking at getting to retirement.
Harry, it's been doing this, as you know, over 30 years, and it's just remarkable.
I mean, you've seen multiple people retire.
I've seen multiple people retire. I've seen multiple people pass away. We have seen those assets move to the next generation, and while the children of the next generation are grieving the loss, of their parent or parents, it's simply amazing to watch and listen to their comments about, what their parents left behind, how they were able to spend the money that they did and still leave behind, a pretty sizable nest egg for the next generation.
Short break, Chuck. We'll have one more power segment straight ahead. I know Chuck is going to get into the year 2017 as well. What we're calling the year of transition. Obviously, that's very accurate. New administration, and I think that's a perfect jumping point from here. Unless Chuck has other items from 2016, he'll share them as well. We'll be back in 90 seconds. Again, you're listening to Chuck Malamut, who for over 25 years has presented this weekly program on Tuesday mornings in the 8 o'clock hour, all about your financial matters. And for all of your financial planning matters, turn to Chuck, the Malamut Group, which Chuck serves and leads as the managing director of his team at Morgan Stanley's Northfield office, the Malamut Group, 609-383-2010 for all of your financial planning purposes. Chuck, also entertain this. Let's do this now, then we'll take the break. Entertain this now. We talk about the importance at the end of the year. If there are any, you may have some really great earnings and you may have some tax implications where if you make the right decisions and the smart decisions, that's what you're advising your clients to do. How important is the very beginning of each year?
Well, Harry, the beginning of the year is an extension of the previous year. And usually, what you see is there's a fair amount of selling as you get to the end of the year, as market participants and clients, look to take the capital gains that they have and somehow mitigate them, in a very, very legal way, so not, to avoid paying unnecessary taxes. Usually that carries over into the beginning of the following year, and what we saw in 2016 was exactly that. But as we woke up this morning and we're looking at the equity markets, we are seeing a rather positive movement, and I think a lot of that is attributable to the fact that while we were closed, the Asian markets traded very well for a couple days. So, Harry, we are within a earshot of that big number, that 20,000. I'm going to say as we open this morning, you're probably within 50 points of getting to that number. So
wow. I've been waiting for it.
Now, I know that
I get more excited about that than you do.
Yeah, but I'm kind of excited about it because it is a milestone. I think what a wonderful way to start the year. if somehow we could push through that number today. Imagine
I would love it.
First trading day of 2017, you get to that remarkable number.
And by the way, so that there can be no misconstruing, when I say I get more excited about certain numbers than Chuck does, that's a compliment to Chuck. It's because he's been doing what he's been doing so well for over 3 decades, and he takes a very sobering look where really, if you're being honest, the difference between 19,900, 19,980, or 20,000, is more psychological than it is anything else. But to me, there's just something about that barrier. It was like when we hit on this program talking about 10,000. And I remember I was more, as a layperson, I get more excited about the just the beauty of the number than the sobering, professional, polished look that an expert like Chuck would look at it. Back in 90 seconds. Please don't go away. More Chuck Malamut and Your Financial Matters next. Hey, I want to send a quick shout-out to the president of Northfield City Council, Jim Travaline. We do a monthly program together all about Northfield City issues that we've been doing for many years. We started it when he was a candidate before even being a ward council person, let alone ultimately becoming the council president. Also, we broke the news as a program, as we typically do. Breaking news first happens here on Hurley in the Morning more than it happens in any other media outlet in our marketplace. We broke the news that Jim Travaline will not be seeking the council presidency. The votes, I understand, and I say this humbly because I can't make absolute pronouncements about how people will vote, but the votes were there. Every read of political tea leaves, the votes were there for Travaline to continue as council president. He thought it would be a good time, to take a step back. He'll be on city council, but to give someone else an opportunity to serve. And again, this is an unscientific sampling, but just because of doing my job every day, I think I can say this with almost certainty that I believe the next city council president in Northfield will be DeWeese. And I didn't say that, and I could have said it weeks ago during December before the reorganization. So in any event, congratulations to Travaline on his decisions. And incidentally, it's not impossible that Travaline might throw his hat into consideration for a seat in the New Jersey General Assembly in District 2. We'll keep you posted on that, and his next visit in the new year will be happening, in the next couple of weeks. Back to Chuck Malamut, our official financial advisor for the Hurley in the Morning program.
So Harry, let's kind of finish up. So we gave you the final results. I think what a lot of people certainly did not recognize is the price of crude. If you remember, it got down to the mid-20s. When the world was kind of, teetering as to, the next steps. And now, if you look at, we closed in 2015 with oil, West Texas at $37.13 a barrel, traded down to like 26 and change, finished the year, Harry, at 53 3/4. So the movement of crude year over year was up 44%, which obviously benefited all the energy stocks. And a lot of people had given them up for dead. And the fact that the production was cut in Saudi Arabia was helpful as well. But I think the good news is that nationally speaking, that the price at the pump only moved up 13%.
Wow.
We were at $2.31 nationally speaking at the end of this year versus $2.03 the year before. So,
do you think with the potential, I know that the outgoing president is trying to lock up, Alaska and some of the other areas where perhaps additional exploration of, or just the actual access to shale, to horizontal drilling, to new drilling. Do you think just the specter of a businessman being president and the I'll just use the word just because for brevity, but I don't mean it in an aggressive way. The threat that America could become more energy independent. Right now, according to everything that I've learned, Chuck, we produce 1/2 of what we use on a daily basis. We have the capacity. We need more refinery capacity because we haven't done any of that in way too long, but we have the potential to be energy independent. Could the threat of an energy independent America, or at least a less dependent America on foreign petroleum, for example, could that bring oil down to levels we haven't seen?
Well, Harry, I think that oil trades on supply and demand, and a lot of it, I think think about it from the perspective that if the economy continues to move in the right direction, earnings increase, and there's more of a demand for the product, you have to have the capacity to be able to produce that oil at a certain price. So I'm not quite certain, if in our lifetime, yes, wouldn't it be wonderful if we could become energy independent and not rely on any other countries? I seriously doubt that is going to happen over our lifetime, but maybe over future generations, Harry. I think that's a very, 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 very strong probability. What I think is happening, and we're starting to see, the president-elect is hitting the ground running with respect to these various initiatives. And what I heard the other day, Harry, I'm sure you heard this as well, which is mind-boggling, that President-elect Trump plans on abolishing 70% of what President Obama had put into place during his presidency.
Yeah, I'm surprised it's that low.
Well, maybe he hasn't had time.
Yeah, I just thought I would just add a little levity to that. Obviously, the number you cited is enormous, and the only thing they're debating is there was one possibility that in one executive order he was literally going to undo every single one that was done. There was some legal question as to whether that was valid, and it was determined that he could do that. But I never rooted for that, because even a broken clock is right twice a day. There's probably some things that you don't want to overturn. Now, you could overturn them all and then re-implement what you want. But to think about that, to overturn 70 or more %, and this was the most aggressive executive action president that we've ever had, it is going to be a voluminous amount of cancellations of executive orders.
Yeah, I guess it's not that it's unexpected, certainly, but again,
when you run antithesis of what's in and you win, then it's obvious you're going to undo anything you can.
So the question is, and we're running short on time, so I'm going to probably spend a fair amount of time next week on this. But where do we go?
Well, let me throw this at you. What do you and then get to that? What do you think? Like, for example, healthcare. I mean, I've said from the beginning, you can't just simply repeal Obamacare on a dime. There has to be a systematic. If you're going to repeal, you have to be able to replace.
There's a lot of moving parts, certainly. Not only to the
and these moves will factor in and affect markets.
Absolutely, they did before.
The healthcare industry.
Well, think about healthcare, Harry. Actually, as you look at 2016, the worst performing sector, the S&P 500, happened to be healthcare. Healthcare was.
And did they get pounded in the last 5 weeks in particular?
I think, yeah. I mean, that group was down probably from the middle of the year. You think about what happened was that when the world was kind of projecting Hillary Clinton to be the winner, biotechnology in particular got absolutely destroyed, and that is part of healthcare. But when you look at all the sectors in the S&P 500 in the year 2016, energy, telecom, financials were up anywhere from 22 to 27%, and then the laggard, the S&P was up, like I said, over, basically close to 12 for the year. Healthcare was down, 2.7. Real estate was up 3.4s, and I think a lot of that has to do with, Harry, the thoughts that you're going to have an increasing interest rate environment with respect to real estate. So, to answer your question, I think that healthcare is a reason why it was down 2.7%. But now, do you take the contrarian view, and do you take the sectors that did not perform well and use those as potential replacements to the sectors that performed well in advance of the averages? I mean, that's part of again, asset allocation, properly planning, being diversified, and setting yourself in a position where you can get to your goals. And I know oftentimes clients, prospective clients say, okay, I'll get to it, but the days turn into weeks, turn into months, and turn into years, and then decades. And then all of a sudden you turn around and look and say, oh my goodness, if I had only thought about saving, let's say you have 5 bills you have to pay every month. If you created that 6th bill, and that 6th bill was to not only just your 401k plan, but to save for your retirement, what kind of position would you be in now versus, doing that versus not taking that advice. So as we get into 17, because we're kind of short on time, and I think I really want to give this justice, so I'm going to save most of this for next week. The fact of the matter is that we think that global growth is going to improve, not only domestically, but also, globally speaking. The dollar will probably strengthen, as we saw it already this year, and probably get to about parity with the euro. And right now, I think we're at 1.03 as of this morning. Unemployment, and I know we oftentimes kind of chatted about, what is the real number? It's probably going to be at one of its lowest levels in the last 20 years. We think interest rates are going to move higher. We think equities are going to probably, hit the high water mark as we get into the middle of the year. And a lot of that is because of the relationship with respect to price-earnings ratios. We think stocks will outperform bonds. We think small caps and cyclicals will continue to beat large caps. Financials, healthcare, we just talked about healthcare, and information technology will probably outperform energy, utilities, and materials. One of the things we talked about is active versus passive management. We think active is going to work well this year versus passive. Obviously, there's been a lot of optimism with respect to the Trump train, and I think that might fade a little bit as he gets into office, and some of the initiatives that he wants to put into place, might be a little more challenging, difficult to get done. So that is sort of what, on a capsulized version, the year that we think we're going to head into in 2017. Like I said, I want to cover this really in depth with you next week, if it's okay with you.
Absolutely, Chuck. Look forward to it. You've been listening to Chuck Malamut, a financial advisor with Morgan Stanley. The information, views, and opinions expressed on this broadcast are those of Chuck. They do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of this broadcast, subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only. Morgan Stanley Smith Barney, member SIPC. Tell a friend every Tuesday morning in the 8 o'clock hour. The best financial advisor with the best financial radio broadcast in our marketplace.
With a number one in the Muttman pool. Woo! Winner at 53.9%. So, Harry.
Thank you, Chuck.
You can only rest on your laurels for only a short period of time, because we start all up again next week.
And it's very challenging with the over and under. Incidentally, I did check during one of the breaks, Chuck. You started this in 2005, so this is our 12th completed season. And everybody that's a part of it knows you can go back and see how you've done each year. It's really cool. It's like the cloud for this type of endeavor. It's all cataloged where you can see. I've done as well as 5th. I've been in the top 5. Maybe I did even higher than 5th, 4th or so. I've been in it in the final week with a chance, but then always crapped out in the last week. Top 10 almost every year, except one. Top 5 usually, but this is the first time we took it.
But Harry, to get that email recognition, you have to be in the top 3.
I know. I've never gotten that.
And so I'm looking at where you posted it here on the wall.
Yeah.
And there is room
for
several additional emails. So I'm going to put the challenge out there right now in front of your vast array of listeners.
See, you know me, though. I'm not greedy. To get it once, you always want it again. But just like that thing on the wall, the top 100 with the incredible, Michael Harrison and Talkers Magazine. If I never got it again, what an honor to get that with all the smart football people that play in that. is pretty nice.
Congrats again, Harry.
Thanks, Chucky, baby.
See you next week.
You're the man. 47 minutes past the hour. We'll be right back. Your Assemblyman, Chris Brown, coming up in the top of the next hour for the full 9 o'clock hour, his first visit in the brand new year. I'm Hurley in the Morning. This is WPG.